Hi there, hope you're doing great today. In today's quick video, we'll discuss some of the pros and cons of multifamily versus single family, because that's a question we often receive from our investment partners, passive or active. But before we begin, this is just a quick reminder that our videos are for educational and entertainment purposes only and do not constitute tax, legal, or investment advice. So let's begin. Why do we like multifamily, or what are some of the advantages of investing in multifamily? First and foremost, economies of scale, ability to manage multiple units under one roof or maybe just a couple of roofs. You have a diversified tenant base, so if you have one or two vacancies, that doesn't adversely impact operations in a material manner. Of course, we always like to be fully occupied, but there's always a balance between maximizing rents and minimizing vacancy, and having multiple units gives you that buffer or additional cushion. Number two is diversified income stream. Again, you have multiple tenants. You also have opportunity to increase revenue, not just from collecting rent and increasing that at the pace of inflation or more every year, but you have opportunity to create additional income streams by adding services, amenities, things that are benefiting the tenants, and of course that you can get compensated for. And number three, you control the value of the property. Now, you don't control the markets, you can't control interest rates and cap rates, but what you can control is operations. So as long as you're continuously increasing the bottom line, you have opportunity at a minimum to preserve the value of the property, especially in a market contraction period, and during market booms to further enhance the valuations. But as anyone would say, there is no perfect investment, and there are some cons to multifamily. So I'd like to share some of those with you in an effort to present a more balanced view. First and foremost, it does involve a number of units, and as such, buying an apartment building requires a high dollar ring. The purchase price is definitely much higher than what it would cost you buying a single family home. For that reason, people typically partner up either with other active investors, passive investors, or both to make that purchase possible. Second of all, buying an apartment building is effectively running a business. It is more complex. There are multiple people involved, multiple aspects and nuances involved. So if you're not comfortable with that complexity, that may not be the right type of investment for you. And last but not least, in most cases, especially when it comes to larger apartment buildings, you will have passive investors, people who like to invest but don't want to deal with the hassle of daily operations. So if you're not comfortable working with passive investors, that may be a downside for you. Now, when it comes to single family, what are the advantages? Well, contrary to multifamily, when you're dealing with one house or possibly even a duplex, you're definitely looking at a smaller dollar ring and something you can probably afford to buy by yourself, which leads us to the second advantage, namely you have opportunity to retain 100% control of the property, because again, you're not dealing with other partners or investors. And in single family, it's not uncommon for tenants to stay longer in the unit. Apartments tend to experience higher turnover, especially if it's a smaller unit. In the single family space, it's not uncommon for tenants to stay 3-4 years, which of course is great from a profitability perspective because it minimizes vacancy as well as turnover expenses. But as we shared with multifamily, there are certain disadvantages or drawbacks within the single family space as well. Namely, particularly once you start accumulating multiple properties, now you're dealing with many roofs, multiple individual units. and you lose that ability to leverage economies of scale. And in some cases, if they're scattered around maybe different cities or even different states, then you're also likely dealing with different teams, like different property managers, different contracts and such. So it becomes a little bit more complex to manage. Number two, there may be potential limitations in terms of financing. Now, if you're specifically looking at Fannie Freddie loans, those are typically capped at 10 per investor. That is not to say you cannot buy more properties thereafter, but then you would lose some of the benefits that the Fannie Freddie type of financing allows. So you're limited from that perspective. And last but not least, number three, unlike multifamily, single family, the value of the property is based on comps. Of course, as an investor, you will always look at the bottom line, you will always look at cash flow, but at the end of the day, when the appraiser comes in or when the bank is making that investment decision, they're first of all underwriting you individually versus focusing on the asset and the cash flow. They do look at that, but they'll focus on underwriting you as an individual. And when valuing the property, they would look at comps versus taking into consideration the NOI and market cap rates. So we hope you found today's video helpful in presenting a more balanced view to compare and contrast multifamily and single family to help you make that decision as to where you'd like to focus next. And if you found the video helpful, please like, share, and subscribe, and we'll see you at the next one.